Hey guys, I just want to bring up an opportunity for resource investors. If you want to rub elbows with the big wigs and talk to companies directly that are handpicked by Rick Rule, well, you got to be in Boca Raton from July 7th to 11th for the Rick Rule Symposium. The event has become a premier event in the mining space, and they're going to have some pretty big speakers like Robert Friedland, Sean Rusin, and the great Rick Rule. And also, we're going to be there. You can meet the deep dive team in person. So if you're interested in rubbing elbow with some of the biggest heavy hitters in junior mining, check out the link below. Good afternoon, everyone. Today I'm chatting with Derek White from Ascot Resources. Guys, I think that Ascot's a really interesting company to have on today because they are on the precipice of gold production. They have acquired one of the 3 mills that exist in the Golden Triangle. They have a sizable resource to put into that mill via their hub and spoke model. And I think that they took some very interesting and creative approaches to project financing to get themselves to the point where they recently did their first gold pour. All right, everybody, enjoy the interview. Derek, thanks so much for joining us today.
Yeah, thanks for having me, Steve.
So we've been hearing some reports online of names such as Stanley Druckenmiller and Michael Berry that are starting to place some big bets on gold. Now I'm curious, you guys have a pretty big asset, a pretty big production plan here, and I imagine you're talking to some pretty serious investors. I'm curious from your view, how has the conversation with those more serious institutional investors been over, say, the last 12 months or so? Is there anything that's sort of picking up, or is it kind of consistent with where it was a year ago?
Well, I would say that there's a couple big trends that are happening. So the first one is that, a lot of bigger generalist institutions used to come into the gold space, and normally it was a tool to avoid risk. And there's both geopolitically in the world, and then also just with the Fed and what's been happening with interest rates, there would have been more interest. In the last probably 3 to 5 years, we've seen a lot of institutional capital flow towards the tech sector because of the big stocks in the U.S. stock exchange that are making people a lot of money. So I would say there's a core of institutions that are very, very bullish on where gold's going to go, and we've seen that happen. And I would say the other institutions are starting to come back to this because they see a lot of value in what I would call undervalued stocks at much higher metal prices. And a lot of people who buy gold mining companies are buying it as a kind of leverage play on the gold price. So if they think the gold price is going to do really well, they can do better by buying a gold stock than by buying the bullion themselves. Now, the gold price has definitely outperformed the gold stocks over the last little while. And I would say that gap's starting to close, and more people are becoming interested because they see a value proposition to invest in.
So it's the first time we've had you on. I think it'd be good to maybe introduce our audience to Ascot. What's the high level overview of the company?
So Ascot is we're management wise, we're a bunch of engineers who tend to look for assets that are brownfield expansions or someone abandoned a mine. And, we come into the company and rebuild it for usually less capital than you would if it was a greenfield site. And we like to get into production, and, if we can move with the cycle at the same time, we offer investors, a pretty good value proposition. In the case of Ascot, there was a mine that was originally owned by the Guggenheim family in the 1920s. And this mine was the largest gold mine in North America and the British Empire for about 30 years. And it had a fire in 1955 and it burnt down, and the Guggenheims kind of let it go. And then in the 90s, basically a Canadian and then a Swedish company built a new mine and a new mill. And they ran it till the end of kind of the 90s. Gold price had dropped to $300 an ounce, and they were a nickel and copper company, and they just put it on care and maintenance. And then really in 2018, we came along and said, hey, look, we see a lot of amazing infrastructure here, and we see an opportunity where we've got a lot of gold. This is located on the Alaska-Canada border in northwest British Columbia, and it's an area called the Golden Triangle, which is known for prolific gold and copper deposits. And we said, look, we can get this back into production much more quickly. And so, we can take advantage of this very high gold price right now. And as a junior mining company, we went through a lot of the hard yards that are necessary to kind of get through that. And in this area in the Golden Triangle only has 3 processing facilities. 2 are owned by Newmont, and the other one is owned by us. And so for people that are interested in, getting a new mine that's coming into production, and it's built and it's basically starting to operate in a very high gold price environment, we think we have a lot of value for investors. And part of the problem, I guess, in today's world, and maybe not so much for the retail investors, but especially for institutional or more sophisticated investors, is risk. People don't want to necessarily have a lot of risk. And in the mining kind of curve, the highest level risk is buying exploration companies. And then you go into this development phase where you're trying to build a mine, and basically there's a lot of things that can go wrong, and there's a lot of capital, and it's never on time, and there's a lot of different issues. And Ascot's kind of got over those 2 parts of it. And then you're into the ramp up of operations, in which tends to have big value moves once the commissioning of the mill and kind of after your first year of production, things settle down. And if you're doing well with the price, there can be some very big value moves. And that's really where Ascot is right now. There's not too many of us out here, just because it's a very hard road to go sometimes. But, I think we're well positioned to take advantage of where we see gold, especially at sort of $2,400 an ounce. That's a pretty good opportunity for us.
So you guys have one of the 3 mills within the Golden Triangle.
Correct.
How did you guys manage to score the mill? I assume that this was a pretty highly coveted asset.
Well, I guess one man's treasure is the next man's junk. Bullion was a Swedish company that owned this infrastructure. It's about a 25-minute drive from Hyder, Alaska, or Stewart, British Columbia. And they had no interest in it. They're really a nickel copper company that operates in Scandinavia, and they're not really focused on this. And we kind of, in 2018, the gold market was, gold was around, I don't know, $1,200 an ounce. And they just weren't interested in it. And we said, look, we see value here in all this infrastructure, because the last mine that was built here was built in 2017, and it was about $1 billion. And in 2024, that would be in $1.5 billion. So we said, look, yes, it's like an old house. You have to fix it up, and there's some things you have to do, and you have to meet environmental standards of today, which were different than what they were in the 1990s. But you get so many advantages that you wouldn't get if you were doing this from scratch. And so they didn't really see a lot of value in it, and we did. So we were able to buy it from them. And I don't think there was other people who were really thinking like this. And we said, hey, look, we can see many deposits around this mill. And if we can get this infrastructure in place, because the Golden Triangle in this part of Northwest British Columbia and Southwestern Alaska, it's very mountainous. There's just a lot of challenges infrastructure wise. And so we saw, hey, look, there's a pretty big opportunity here. And so we had done this before with other mines in different parts of the world. And we saw that kind of opportunity, and they were like, hey, good luck. And so we were able to buy it from them fairly cheaply, and then start the process of getting it up to 2024 standards. And it's not like it's zero capital. We've still spent about $250 to $300 million US to try and get it up to this level.
So your investor presentation and your marketing materials describe what's known as a hub and spoke model, which is obviously centered around the mill that you guys have acquired. Can you give us some sort of a sense of the cost to mine that, like, I know you guys aren't like at scale production right now, but do you have any sense of how much it's going to cost on a cash basis to go and mine gold?
Yeah. So when we did the feasibility study back in 2019, the costs that we were looking at, all in costs, were something in the neighborhood of around $770 an ounce. And when COVID happened in 2020, I'll call it 2021, 2022, the world experienced some weird inflation. So we had suppliers not supplying stuff and all kinds of different things. And I'd say that the entire industry, and like many industries, got escalated up. And our costs probably rose to somewhere around $1,050 to about $1,100 an ounce. On the other side of that, also the gold price rose up, so the margins are better. But yes, we experienced inflation. The cost of people, cost of food, supplies, everything just moved up. And so I would say from the feasibility study to where we are today, we're kind of probably more in that type of range, which is still, for the industry, not too bad.
Mm-hmm. And there's still quite a bit of upside. Do you guys have any sort of forward contracts or do you guys hedge the price of gold or anything?
No, we haven't done that. And we don't really like to take the upside away from investors. So if we're going to do something like that, we're typically buying puts where we have an option as a floor price, but we're not going to put a ceiling on it. And the other thing is when you're starting a mine up, you go through, just because we turn the mill on, it doesn't mean everything runs smoothly from day one. We have, a whole commissioning time frame to get things up and running. And we wouldn't want to put in contracts until we were very comfortable that we knew what our production was and we've settled out all the kinks and, we know all that. I think the second thing is that if we'd put in a hedge, say a year ago, we would be pretty upset with ourselves because, gold has moved quite a lot in 1 year. So right now, if the gold price continues to go up and we kind of get our production, maybe we'll buy some puts to protect the floor, but I don't think we're going to take the upside away.
So you guys plan to get to 150,000 ounces of annual production. What does the timeline look like to get there?
So in a hub and spoke model, we have these different deposits that we're developing. And usually for the junior miner, it's about how much development can you do. So the way this works is we start with the big Missouri mine, and then in roughly October, we'll bring in the Premium Northern Lights mine. And then in the fall of 2025, we bring in the Silvercoin mine, and we start to ramp up to that number basically when we have these three mines all feeding the mill.
So what are the big hurdles right now if we're talking about getting to sort of that production, maybe not even 150,000, but if you wanted to get to say, that 80,000 plus, what are the big hurdles that we're looking at? If I'm an investor and I'm trying to evaluate the risk of getting there, what am I concerned about?
Yeah. So the first probably concern is, everybody knows that when we build these mills and, the way our process works is we have design engineers design a mill, and then an operating team has to operate that. And we finished our construction basically at the end of March, and now we're in the commissioning phase. And that commissioning phase usually goes 3 or 4 months. So let's call it August of 2024. And, there's a lot of things that go wrong. You turn things on, they don't just work. It's kind of like you build something and you got to troubleshoot something. So I think investors are always nervous about, hey, how well did that commissioning process go? And are you commissioning well, or are you having trouble, or what are the different issues? And during this 4-month period, I understand you passed the first big hurdle, but you've got to pass the second hurdle, which is the mill running steady state? I would say that's one thing. I would say the other thing is just making sure that the mining development and feeding the mill with the right amount of grade and ore, that's another one that people want to see us go through. And, there's institutions and retail investors look at that and say, okay, I want to see you pass over those things. And typically, once that happens, there's quite a re-rating in people's stock because they see the risk has been eliminated. And we're kind of in the middle of that commissioning process right now.
So we've seen some companies in Canada that have gotten to production, and then the project financing that they did basically made them collapse under the cost of servicing that debt. How do you manage that risk when it comes to project financing? And can you maybe give us some insights into how you guys have managed to finance getting the mill up and running?
Yeah. So what we did is because we have a lower capital because of the fact that it's a brownfield site, but we still had trouble financing it. I mean, it's still not easy for us to finance it. What we did is we reduced the debt to quite a small amount. So we don't really have a lot of debt, and we have a stream and a royalty arrangement with a streamer. And the way that works is it's a little different risk than you have with a debt. A debt has a fixed payment, and whatever happens, you have to pay that fixed debt amount. With a streamer, they just take a percentage of your production. And if you produce 0, then they take 0. If you produce X, they take a percentage. So in our case, the way it works is we raise most of our capital through a stream, and that stream starts at about 8.75%. So whether we produce 8.75% is paid back to the streamer, is effectively the way of giving back the capital that we borrowed to effectively build it. And after we produce 150,000 ounces, after we pay them back 150,000 ounces at this percentage, then that stream drops in half, and we have the right to buy another half back. So we can take that 8% and drop it to 1/4 of that. And then the streamer has the upside being, so let's assume we did that. So roughly 2%. And if we find more gold, they'll continue to get 2%, as long as the property's going over. And it's not the entire property, it's certain portions of the property, but in the areas we're mining right now, they have that stream available. So the risk profile here is a little different. So it's not like you're going to collapse, but on the other side, you're giving away certain amounts of the upside because the streamer has financed you, and effectively it's kind of like buying a sports athlete. Like you're going to take some of their winnings. If they do well, you get some of the winnings. If they do terrible, you don't get anything. But you don't go into bankruptcy. And that's kind of what our situation is generally like. We have a little bit of debt, but not really a lot.
Just so I understand, that 8.75% up to 100, the first 150,000 ounces of production, that's basically a top line.
No
revenue.
So yeah, it's a top line, but it's not. We have to pay them 150,000 ounces out of 8% of our production, whatever that production is over time. So once they've been paid back 150,000 ounces, then that drops to half, and we also have a right to buy it back by another 50% to drop it to 1/4.
All right. So you guys also mentioned in your marketing materials that Ascot's going to be amongst the lowest carbon producers. How do you guys achieve this?
So one of the great advantages of the infrastructure that we found was that in 2013, they built a hydroelectric plant basically on our mine. And there's a big mine in Canada called Brucejack, which is about 25 kilometers north from us. And ourselves and Brucejack take power from a hydroelectric dam. So the energy that we use is fairly green. We don't use a lot of energy because we're an underground mine. And the electricity we have is coming from a natural source, which is effectively, we run a pipeline effectively from a lake, and it runs through 2 generators and it generates our power. Because we're an underground mine, we don't tend to use a whole lot of diesel fuel compared to a lot of the mining. So those 2 factors basically impact our carbon footprint. And really, that's what's driving the fact that we're such a low carbon producer, a carbon user, sorry. Carbon emitter.
Yeah. Last question for you, Derek. If I'm an investor watching the company or a potential investor trying to evaluate management's execution, what am I looking out for over the remainder of 2024?
Well, the biggest thing is just, are we commissioning the plan, and are we delivering the mining grade and stuff as advertised? And that's going to happen over the summer of 2024. And if we're able to do that and bring it up, then we've done what we said we're going to do. And after that, you're then really saying, okay, you might have some more upside in your growth potential. And we have exploration that we're doing as well, which we think is quite good. And so you're starting to add on to that base story. And if that goes well at a $2,400 gold price, there's a lot of value relative to what you see in our share price to what that could be. So that could be quite attractive.
Well, Derek, I appreciate you taking the time to hop on here. I think that it's great to see companies that are managing to get these stories up and running. I think you guys have a very fascinating story. I know that it's really challenging to get a mine up into production. So I'm definitely rooting for you as somebody who invests in Canadian junior stocks. And hopefully you'll come back on here in the future as you guys continue to scale up your production and give us more insights into how everything's coming.
Thank you very much, and thank you for having me on your show.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Thanks, everyone.